So you want to get into ETF investing and you just don't know where to start. Or your portfolio is just full of boring Vanguard funds that everybody else has and you want to expand a little bit outside of that to something maybe a little bit more exciting. Or maybe you're just here because you want to learn about some great ETFs that can make you thousands of dollars in the long run. Well, you've come to the right place because that's exactly what we're talking about today. And what better place to start than by talking about the biggest issuer of ETFs in the world, Blackrock, or as you might know them by their ticker name, iShares. Today, I'm going to walk you through 7 of the best iShares index funds that you can invest in. And don't forget to stick around to the very end because I'm going to reveal my absolute favorite ETF from Blackrock, which has made me tens of thousands of dollars over the past couple years and has actually been their highest performing ETF over the past 5 years as well. But before we get into it, don't forget to give the like button a tap and subscribe to my channel so I can keep helping you on your path to financial freedom. So Blackrock currently has $2.4 trillion of assets under management, or AUM. And yes, that's trillion with a T. It's a lot of money, and it's actually significantly more than any other issuer on the market, and that's including Vanguard. And a quick fun fact about that $2.4 trillion of AUM is their AUM weighted expense ratio is 0.19%, which means they earn $4.6 billion of fees every year. Now, that's enough for them to go buy Lyft in cash every single year. And that's Lyft, the entire company, not just a car or fleet of cars, literally the Lyft. They can go and buy in cash every single year with how much they're making off of the expense ratios. So this is an obscene amount of money. It's a really profitable market to be in, and they're just raking it in. But at the same time they're raking it in, they're also providing investors a really great opportunity to make a lot of money and to be passively invested, and there's a lot of benefits for us. So now we get to the age-old question of should I buy ETFs or index funds or stocks or some other financial instrument? And I'm actually not going to go into too much depth into that into this video. I do have some other videos that I'll link in the description that you can check out. But really the most important thing, ETFs are really simple to trade. It allows for great diversification. Generally, they're passive and they have really low expense ratios, and they are fantastic options for new investors. Index funds are very, very similar, and sometimes they're virtually the same. Just the method that you trade them is a little different. So index funds trade on a different exchange, essentially, where they only trade once per day, whereas an ETF operates very similar to a stock, where you can trade in and out multiple times per day. And then, of course, a stock, I honestly see stocks as being a little bit more for an advanced investor. It's harder to be diversified. They carry more risk, which means there's a lot more downside, but there's also more upside. So just know that if that's what you're looking to do. But again, I always recommend ETFs for not only brand new investors who don't know what they're doing, but extremely experienced investors. As Warren Buffett has said many times, generally people fare the best if they just buy and hold great ETFs for the long term, and they will be set for success for the rest of their lives. So definitely what I recommend too. So again, if you want to learn more about the basics of ETF investing, I go into a lot more depth in another video. So I'll link that in the description below. So if you guys want to check that out after this video, please do so. Now I've given a little structure to these 7 ETFs that I'm going to walk you through today. The first category is your core ETFs. And these core ETFs should generally make up the bulk of your portfolio. And they're going to track broad indexes like the S&P 500 or the NASDAQ or the Russell 2000. These are generally where you want to have the bulk of your portfolio in. So I have 2 core portfolio ETFs. I have 1 dividend ETF, 1 bond ETF, 1 international ETF, and then 2 sector ETFs. So those are the 7 that I'm going to walk you through today. And don't forget to stick around to the end of the video because I'm going to reveal my absolute favorite sector ETF. All right, so our first core ETF that I'm going to walk you through is IVV, and this is an ETF that tracks the S&P 500. So first, on the iShares website, you can see they have a great overview of why this fund and then the investment objective. So IVV has an exposure to large established US companies. It's low cost, tax efficient access to 500 of the largest cap US stocks. And you can use this at the core of your portfolio to seek long-term growth. So looking at the growth of $10,000 over the last 10 years, you can see that had you invested 10 years ago, your $10,000 would now be worth $38,500 or a 284% gain. And some other really important facts about the fund: the fee structure is incredibly low, here just 0.03%. And you can see here some of their top holdings. So again, these are the top companies in the S&P 500, and you can see them weighted appropriately. So Apple, Microsoft, Amazon, etc. All right, and our second core ETF that we're going to look at today is ITOT, or the Total US Stock Market ETF. So why ITOT? It's a low cost and convenient access to the total US stock market in a single fund. It has exposure to the total US stock market, ranging from some of the smallest to largest companies. And again, you can use this at the core of your portfolio to seek long-term growth. So again, this is a really great fund if you want to have a little bit more broad exposure, broader than just the S&P 500. So this will allow you access to way more companies and way more diversification than just the S&P 500. So looking at the growth here of $10,000, if you invested 10 years ago, you would have about $38,000, or you'd be up 282%. So again, this is very similar to the S&P 500 ETF we looked at earlier. So that's why these are core ETFs. You don't really need to have both of them or multiple, because there's going to be a ton of overlap between the two. So honestly, one of these would be enough as like a core ETF in your portfolio. And looking at their fee structure here, again, very similar to the S&P 500 fund. The expense ratio is incredibly low, just 0.03%. And you can see very, very similar holdings. Again, the biggest difference here is that instead of just holding about 500 companies or stocks in their portfolio, they'll have thousands. And as you can see, they actually have 3,600 as opposed to just 500. So now looking at our third fund on the list, this is our Dividend ETF. The ticker here is HDV. And why HDV? So this gives you exposure to established high quality US companies. It has access to 75 dividend paying domestic stocks that have been screened for financial health. And you can use this at the core of your portfolio to seek income. So really the main purpose of having a dividend ETF is if you want fixed income coming in every month. So if you need to pull cash out of this without pulling out of your principal, then this will allow you access to some amount of consistent funds every month. Looking at the growth of hypothetical $10,000 for this dividend ETF, you can see over the course of 10 years, your $10,000 would have grown to $27,500, or you'd be up 175%. And the fee structure here is also incredibly low, just at 0.08%. And you can see the top holdings here for this ETF, starting with Exxon, we have AbbVie, J&J, Chevron, just a number of really, really large, mature companies that are going to be paying great dividends. You can see this fund is composed of 81 of them. And now moving on to our fourth ETF that we're going to talk about today. So this is our bond ETF. So this will definitely be the least exciting from a performance perspective, because generally the idea behind bonds is that it's the most stable. So in economic downturns, generally you're not going to have the wild swings that you do with other equities. So that's why people like to invest in bonds. And you might hear that as people are getting closer to retirement, you might want to shift more and more of your money into bonds because you have a lot less volatility. So that's really the allure behind bonds. So the ticker for this is AGG. It's the iShares Core US Aggregate Bond ETF. So why AGG? Gives you broad exposure to US investment grade bonds. And I'll explain what investment grade is here in a second. And it's a low cost, easy way to diversify a portfolio using fixed income. And again, use it at the core of your portfolio to seek stability and pursue income. And as I mentioned, the growth of the hypothetical $10,000 here isn't quite as exciting as the rest, which is expected. So you can see over the course of 10 years, your $10,000 would only be about $12,000. So you'd be up 18 to 20%. Not all that exciting. But I think what's interesting here, if you look at the since inception, which was in 2004, you can see how it's very, very rare that this fund actually decreases in value, which is very different from some of the other ones. So even in 2020, you can see it had a very brief dip and then was back to stable. Of course, It's not exactly playing out as you would expect right now. So we've had a massive dip. But even in 2007 to 2009, during the great financial crisis, it was basically positive, just a very minor blip here, and continued to rise. So that's really the allure of bond ETFs. And the expense ratio here, also very, very low, 0.03%. You can see their top holdings here: US Treasury, some mortgages, Bank of America, JP Morgan Chase. And what's really interesting here is looking at the credit quality. So anything that's BBB and above is going to be your investment grade. So these four categories. AAA is your absolute best. And what these ratings mean, this is basically a measure of the risk of whatever company is issuing the bond has to default on their loan or basically go bankrupt. So AAA rated means there's virtually no chance that these bonds are going to go under, or the company is going to be insolvent. So anything above BBB is generally known as investment grade, which means it's extremely safe. All right, moving along now to our fifth ETF from iShares that we're going to talk about today. And this is IXUS, or the Core MSCI Total International Stock ETF. So why IXUS? It gives you exposure to a broad range of international developed and emerging market companies. It's low cost and comprehensive access to non-US stocks. And again, you can use it at the core of your portfolio to diversify away from the US to seek long-term growth. And the hypothetical growth of $10,000 here, we can't quite get to 10 years because the fund was released in 2013. But you can see over the last 9 years, you would be up 63%, or your $10,000 would now be $16,000. And your fee structure here is also incredibly low at just 0.07%. And you can see some of the top holdings, so Taiwan Semiconductor, or TSMC, the biggest semiconductor creator or manufacturer, Nestle, Tencent, Samsung, Roche, and a number of other really large international companies here. And you can see this ETF is composed of 4,468 other companies. So again, really broad exposure all over the world here. Now for number 6, and this is our first of 2 sector ETFs. So this is ICLN, or the Global Clean Energy ETF. So why ICLN? It gives you exposure to companies that produce energy from solar, wind, and other renewable sources. It has targeted access to clean energy stocks from around the world, and this allows you to gain a global sector view here. So looking at the hypothetical growth of our $10,000, you can see over the course of 10 years, your $10,000 would now be worth $37,500, or you would be up 274%. So really strong growth here. And looking at our fees, you can see the fee structure here is quite a bit higher than the others that we've looked at. And this is because this is generally what you see in sector ETFs. But really anything under 0.5% is still really good. And the fee structure here is 0.42%. Where I would start to get worried is anything over about 1% is really when you'd want to be a little bit concerned about the expenses you're paying. And you can see the holdings here, again, a bunch of renewable energy companies, looks like about 132 of them. All right, now our 7th and final ETF that we're going to talk about today, and our second sector ETF that we're covering. And first, thank you for sticking around this long in the video. This is the bonus ETF I was talking about, and we're looking at SOXX, or the iShares Semiconductor ETF. Again, this is one of my absolute favorite ETFs. I've been invested in this for a long time, and it's made me a lot of money. So really happy to have this in my portfolio. So why SOXX? Is it gives you exposure to US companies that design, manufacture, and distribute semiconductors. And it gives you targeted access to domestic semiconductor stocks. And finally, looking at our growth of our hypothetical $10,000, you can see that over the course of 10 years, your $10,000 would have gone from $10,000 to over $100,000. So you would be up over 900%. So absolutely insane, which is why I mentioned this has been one of my favorite investments that I've had. Again, Really important to remember, previous performance is not indicative of future performance, but I'm still really bullish on semiconductors, and I think that this is still a good ETF to be invested in. And then looking at the fee structure here, still fairly low at just 0.43%. And obviously with that performance that you saw over the past 10 years, they more than justify the little bit of extra expenses here. And their top holdings, as you would expect, just the top semiconductor companies in the US, so Broadcom, AMD, NVIDIA, Intel, so on. And there's about 35 of them that they're invested in. All right, that wraps it up for the iShares ETFs that we're gonna cover today. If you're curious about which ETFs have been the absolute top performers, not just iShares, but in the entire ETF market this year in 2022, despite all the craziness with the stock market, yes, there are still a number of ETFs that have been absolutely killing it. I will link that video down below. I made a video on it. Go check it out so you can see which of those ETFs have been the best performers. And that wraps up the video, guys. I really hope you liked it. I hope that you gained a lot of value out of this. So please don't forget to smash the like button and subscribe to my channel so you don't miss any more great content that I put out in finance and real estate and business. And again, thank you guys for watching, and I will see you in the next one.